GM, good morning. Welcome to the Milk Road Show, the daily crypto show that hits the mark with precision, just like Olympic shooter Yusuf Dikesh. I'm your host, Jay Hamilton, and today we're joined by Kyle Reedhead, the master of charts and co owner of Milk Road. Kyle, on Wednesday's episode, we talked about two questions which you asked yourself after the markets dumped over the weekend. You said, does crypto tech still work? And is the business cycle still intact? You answered yes to both of these, indicating that you strongly believe that this recent sell-off is a dip, not the end of the bull. The question on everyone's mind, which we actually got quite a bit of comments on, was how do you know that? What gives you so much conviction that this business cycle is still intact? I don't think anyone's arguing that crypto tech still works, but the business cycle is a little bit more up for debate. So we brought you back on the show today so that you can explain your thesis on how the business cycle works and tell us where you get your conviction from that we are still in another typical cycle. Let me begin with my first question, which is, what is the most important factor that impacts these cycles that we're in?
I have a working thesis that dates back to the 1940s. I was obviously not around then, but as you said, a master of charts, I like to look back at charts and kind of look at history. And so I have this working thesis. It doesn't mean this thesis is right. It doesn't mean it's going to come true, but I have a thesis as to what I believe is happening in markets currently and have been for a while and will continue to over time. And so I'm going to kind of walk you guys through this. This comes from a bunch of different other let's say macro gurus that I listen to and sort of their opinions and thoughts and sort of piecing it all together. Um, it what I'm about to explain is, I mean, something I've said a bunch, although we'll go into more detail, but it very much simplifies the business cycle and simplifies the way to invest in markets, which is right now we live in a world where we're dominated by monetary policy. And that means we are dominated by printing of money and interest rates. Okay. And what I believe is that liquidity is what drives markets. I've said this a ton. I think you've heard this a lot in crypto. Everyone says this. The business cycle right now is driven by liquidity. And that means central banks printing money, taking out debt, et cetera, et cetera. Okay. And so what I always look at is where's the liquidity cycle at? Because basically, if you look at liquidity, you can understand where markets go. If we look at the chart we have up on the screen right now, this is looking at liquidity since 2014, so global liquidity. And every time global liquidity rises, Bitcoin rises. Every time global liquidity goes down, Bitcoin goes down. It's almost identical, except for the fact that Bitcoin overshoots it a lot, although that's starting to stop happening. It's still following it like correlated so well. And by the way, this is not just Bitcoin. This is all markets, real estate, tech stocks, almost everything that is scarce follows this exact same idea. And the idea here is basically as we put more liquidity into the system, as we take out more debt, as we print more money, what's happening is we are debasing our fiat currencies. As we debase fiat currencies, scarce assets go up in price. They have no choice but to go up in price. We are creating more dollars or more fiat, but we are not creating as much or more of scarce assets like real estate, like Bitcoin, like tech stocks, right? There's only one Apple, one Amazon, et cetera. Yes, there can be more tech stocks, but they all end up funneling under these 7 stocks anyway. It's pretty tough to get a new big tech stock. And there's only a certain amount of shares you can get of those. So technically, tech stocks are also scarce and they are growing, right? And so the sort of thesis here is that if we follow liquidity, we can follow where markets go. And if we look at liquidity, it moves in cycles. And you can see here that basically what happens is every 4 years or so, we have a liquidity cycle where liquidity increases. And then at the end of that cycle, it starts to decrease and then, or starts to slow down, doesn't necessarily decrease, but the amount of new liquidity coming out lowers. Okay. It decelerates, let's call it. And then eventually it accelerates again. And we keep going through these cycles. Basically, what's happening is governments are taking out more and more debt. You've heard this all the time of the doomsday scenario of we have too much debt, we have too much liquidity. I don't necessarily think we have, I mean, yes, we have a ton, but I don't necessarily think that that's the end of the world. But ultimately, what's happening is that markets are just following central banks and following the amount of liquidity that is coming out. And so you can see this in terms of our liquidity cycles are every 4 years. And so is our crypto cycles. Even it's not even just crypto cycles. We always think of these 4-year cycles as crypto ones. mainly because of the Bitcoin halving, which also falls along the same time frame. By the way, the reason that is true is because these cycles that I talk about, liquidity cycles, happened from 2008. In 2008, when we had the financial crisis, governments all came together around the world. They set interest rates at zero, and they started turning into monetary policy. And monetary policy took over rather than just like normal business cycles where it was controlled just by like supply and demand of markets. That doesn't happen since 2008. Now we are just cycles based off liquidity. And it just so happens that Bitcoin was created the same time as the financial crisis happened, right? It happened because of that. And so it sort of lines up with these 4-year liquidity cycles just because it launched around the same time. That's all. And so I don't think that it's the Bitcoin cycle or having that has anything to do with this. I think it's more of this liquidity stuff. And you can even look, I took the bottoms, you can see on this chart here, I took the bottoms of Bitcoin for the last 3 cycles. And it lines up almost exactly, actually pretty much exactly as you look at this chart with the bottoms of the liquidity cycle for every cycle that Bitcoin has been in existence so far. You can also do this with the NASDAQ. Looking at the bottoms of the NASDAQ, meaning tech stocks, is also lined up exactly with the liquidity cycle. So to me, it's very, very clear that is liquidity that does this. Now, our world doesn't always work this way. Usually, when we are not dominated by monetary policy, our world works where business cycles are not every 4 years. They're actually just like kind of random. They can be 5 years or 6 years or 7 years. And it's a little bit more difficult to understand business cycles. But since the financial crisis, and especially since what happened with COVID, we've moved into a world where we are so far in debt versus GDP that our economies and our business cycle is just simply controlled by monetary policy, by stimulus, and nothing else. And so all you need to understand is what's happening with liquidity to understand what is happening with markets. It's a weird world that we live in, but it's the way that it works when debt is so high versus GDP. Now, what do I mean by that? Debt is the amount of money we're printing or the amount of loans we're taking to pay for whatever it is. And then GDP is the amount of money that the government makes, right? The amount of money that the US makes is GDP. Let's call it that. It's the revenue. Think of it like a company, okay? It is their revenue. And what we're looking at is the debt of a company, in this case, the United States, versus the revenue of a company. And the revenue of the United States comes from taxes, right? So the better the economy is doing, meaning the more money people are making at their job and the more money people are spending on goods, the more money the United States makes. When the United States isn't making a lot of money because people aren't making a lot of money and they're not spending a lot of money, we typically have recessions, things don't go as well, right? And in this instance, when we're dominated by monetary policy, we have to print more money to make up for the deficit, to make up for the amount of money we're not making, right? Now, there's one other time, well, not one, I'm sure there's others, but there's one other somewhat recent time that we have been so high in terms of the debt versus the GDP. That was at the end of World War II, okay? And this is what's really interesting to me. And this is what makes me build my thesis around what's happening today, because what happened after World War II is very similar to what's happening today.
Before you jump in, it feels like a cheat code. It's so simple when you say that we are in this monetary policy period since 2008 that has put us into these 4-year cycles. And I feel like every investor sits there and says, well, it can't continue. How can it continue? And it seems like a cheat code. But what you're saying is if markets follow liquidity, which they have been doing since 2008, and we continue to have monetary policy and printing, then they are likely to continue to follow these cycles. Am I correct in that?
Yes. It won't continue forever. At some point, GDP hopefully will catch up. And when the debt to GDP ratio goes down a lot, then eventually we will go back into a world where we are not dominated by monetary policy, but we are back to sort of the normal business cycle where it happens naturally. What you can think of in terms of comparisons here is like right now we have a pacemaker in our heart that's just beating on automation, right? Every second. Whereas when you don't have a pacemaker, your heart might beat 60 seconds, per minute on average, but every beat is not actually 1 second apart, right? It might be 1.2, and then it might be like 0.8, and then it might be 1.4. But on average, it's about 1. But when you have a pacemaker, it's just every single exact second your heart beats, okay? Right now, when you are dominated by monetary policy, we are just like having a pacemaker. And that's why our cycles are almost exactly to the T every 4 years. It's very weird, but that's what's happened the last 3-4 cycles. And we've seen this play out in history before, which is what I'm going to get to. But previous to the financial crisis, for example, we didn't have that. The pacemaker wasn't in. And we would have business cycles that would last 8 years and sometimes 4 years and then 3 years. And it was more sporadic. And it was actually tough to figure out the business cycle. Now it's actually quite simple because it's actually just literally every 4 years, which is weird, but it just happens to be the way it works. But we've seen this play out before. Now, it didn't last for forever, but it lasted for like 2 decades. And where we've seen this play out before is actually the only other time that we've seen the debt to GDP ratio also at the same levels that we see them now. And that was back in 1945-ish to like 1960-ish, whatever it was. And this was at the end of the World War. So if you think, and this is again, I'm looking at the US specifically because it's the global reserve currency and the biggest market. So what happened? Well, World War II, when it ended 1945, the economies were basically crushed all around the world, right? Half of the population of the US was basically over in Europe fighting, and they all had to come back, okay? And basically the economies were put on pause, kind of similar to what happened with COVID, right? Economies were literally put on pause. They couldn't do anything other than like build some military stuff, right, to help fight the war. But when they came back, they're like, okay, our industry's completely squashed. There is nothing. What are we going to do? We've got a bunch of young men that are here that want to start working. What do we do? And the government's like, we're going to stimulate. We're going to print a shit ton of money, take out a bunch of debt in hopes that we can be productive enough in the future that our GDP will go up and we can start to pay off those debts and we won't be so far in debt. That is why governments print money. It is basically like, why do we take out debt? Why do I take out a mortgage on my house? Because I think I can pay that back in the future, right? I'm going to make more money in the future and thus I can pay off that house and pay off that mortgage. It's the same thing the governments do when they print money. They're printing money today because they think they can be more productive in the future and they can eventually pay off that debt, right? Now, everyone thinks it's not possible right now, and we'll see if it is, but it was possible and it did work back when World War II finished. Because what happened was after World War II, we had this whole population where they printed a bunch of money. They said, let's rebuild America. Let's build all these businesses. Let's get everyone jobs. And let's build technology and let's innovate and let's restart our economy. And what happened was, along with printing a bunch of money, everyone who came back from the war was excited. They started having sex with their wives and they had a shit ton of babies. Okay. This is actually a true story. I know this sounds a little bit weird, but what happened was we created the biggest demographic ever in the history of the world. That's the baby boomers. There were so many babies that popped out in the 50s and the 60s. And what happened was over the next 20 years, these babies grew up. Okay. And these babies started going to work. And what happens when you have the biggest demographic in the world all go to work? Your economy becomes very, very productive because all of a sudden you have millions, millions, and millions of workers. Combine that with technology coming in at the same time, right? Where we started to have more things built with electricity, whether that be appliances like dishwashers and fridges or microwaves and TVs and all the things that we have in our home today. Those all started getting built at the same time that we were able to build factories, and we had millions and millions and millions of new workers in. And so what happened was the US government actually made a good bet. They printed all this money, and the economy, which was not very productive back in the 40s and the 50s, became very productive in the 60s and 70s. And we had all these workers that made us grow in our GDP, right? We started to produce things. But let's go back and look what happened to stock markets when we were printing all that money. So this is pre-boomers moving into the workforce, but close to it. Look at what I have up here. The bottoms of the business cycle, and thus the bottoms of the S&P 500 is what we're looking at here, were every 4 years. How weird is that? Literally, you go from 49 to 53, from 53 to 57. 57, we had a bit of a longer one here, which was 62, so 5 years. And then we go from 62 to 66, 66 to 70, 70 to 74. What the heck is going on? Well, guys, this were the years, the decades that we were printing a shit ton of money. The pacemaker was in, okay? The pacemaker was in because we weren't making enough GDP. The government wasn't making enough money to pay their bills, so we needed to print money. We needed to stimulate the economy. But then what happened? As the boomers grew up, and let's look at that demographics chart, as the boomers became of age, 18, 19, they were done school. What did they do? They went to work. This is a chart here looking at the amount of employees in America by age. Anywhere where you see the colors, right? The transparent colors there, that is where the boomers are moving into work. So from 16 to 19, then you see from 2024, they were easily the biggest population ever to start working. And interestingly, they all started working at the exact same time. I mean, not exactly, because obviously the boomers came over like a decade and a half kind of thing. But over 10 to 15 years there in the 60s, 70s, all these boomers came in. And then what happened was all of a sudden the pacemaker was removed. We didn't have to print money anymore because we had a productive economy. And so in that last chart we just showed of those 4-year cycles, all of a sudden those cycles end, right? Now, we don't have it up because I didn't zoom out enough, but if you look at what happened in the 70s and the 80s and the 90s, when the pacemaker was gone, we didn't need to print as much money anymore. We weren't so far as in debt because we had enough people working. And so all of a sudden those 4-year cycles went away. Then it was like, okay, now how are we going to figure out the business cycle? It was more of like something to predict. But back then, what happened was a little bit scary. And a lot of people think that's what's going to happen today. People think that because we printed so much money back then, that it caused the inflation of the 70s, which was we had inflation of like 10, 15%, and it lasted for like a decade. Terrible time to be alive. Not really, but it was a tough time to try to own things because interest rates had to go up to like 20%. If you talk to your parents, I don't know, depending how old you are, but if your parents are a boomer, the first house they bought, if they bought a house in the 70s or the 80s, their mortgage rates were like 12, 15, 20%. And we're worried about like a 4%, 5% now. But it's because inflation was so high. And so what everyone compares is they go, well, we printed all this money back in the 50s and the 60s, and then inflation went high. And so the same thing is probably going to happen now. But what people miss is that inflation in the 70s with that high that stuck around for a decade, that didn't happen because we printed money. It happened because the biggest population, the biggest demographic ever, all went into the workforce at the exact same time. And what did they all do when they turned 20? They bought homes, they bought televisions, they bought couches, they bought appliances, and then they all had babies and they bought diapers and strollers and all the things they needed for babies. And they did it all at the exact same time. And so we didn't have supply chains that could handle that size of population going into becoming an adult all at the same time. And so what happened was, of course, CPI went through the roof, consumer price index. The things that consumers buy went up because there was millions of them all at the exact same time. And it took about a decade to get the factories built up to have a supply chain good enough to build TVs and couches and home and like all the things we needed to supply all that demand. And so by the 80s, we figured all that out. And all of a sudden inflation went down and it stayed pretty low ever since. Okay. So the inflation that happened in the 70s wasn't because of money printing. It was because there's maybe some of it, like a small percentage of it, but most of it was just because of demographics. And so that brings us to today. We're printing a bunch of money. Again, we have these 4-year cycles, the pacemaker's in. So what's going to happen? A lot of people think it's inflation. And I always have been saying it's not inflation because we don't have demographics. Why don't we have demographics? Well, because one, we don't have a war that just happened where everyone couldn't have babies for like 10 years, but also because our fertility rates in women have gone down globally, except for like a few countries, but it's gone down a ton since like 2000. Okay. Now, why is that? I mean, if you look at the births, so we have a chart up here. The births back in like the 50s were like 3.5 on average. We were birthing like 3.5 babies. Okay. Women. Now we're sitting at about 1.5. Okay. Just a little bit above that, but it's down and down and down every year since basically 2000. I don't know, like 2003, whatever that is. Okay. Now, why is that happening? We don't know. There's lots of reasons. Maybe it's too expensive to have kids. The bigger reason that most people think is because of our health. We've become a very unhealthy nation in the last 2 to 3 decades. Obesity rates have skyrocketed, which is well known to lower your fertility rates. And same with basically every other health problem that we have, whether it's because of using too much plastic, because of bad diet, because we are now sedentary, like doesn't matter. But the facts are we don't have really good fertility rates anymore. And so not only can't we have a big boom in births, it just probably also won't happen because it's actually just very expensive to do these days. So it's hard. Okay. So that is out of the question. And so what's the government's plan? They're printing a bunch of money. How do we ever get out of this spiral, right? How can we ever get GDP up enough that it will pay back this debt and allow us to pull that pacemaker out so we're not printing money anymore? The answer to that question, and I don't know if it'll come true, but my thesis anyway, the only answer we have is technology, and specifically AI. Technology is very, very deflationary. But interestingly, AI is a new demographic. It is like a new brain, right? It is like a new person, and you can have infinite amounts of them. So before we had millions of boomers, now we can have millions of AI agents, and they can take over a lot of jobs for us and make our jobs more efficient. And what does that do for us? It means that so many expenses that we have in life, like when we build any product in the world, you need humans and machines to do this. Well, when AI can do that for you, it makes it basically free to build a lot of things. Also with renewable energy, right? Right now we have to pay a lot in oil to transport things and to run factories, etc. But when all those factories go renewables and it takes energy to basically $0, well, that makes the cost of goods to go down. And then you have non-humans building everything. That makes the cost of everything go down. But it also means companies become way more profitable, way more profitable. I can have 10 AI agents do the jobs of 30 humans, and they're basically free, and they work 24/7 nonstop. Now, people are going to get scared here. Look, you will still have a job, okay? Because companies will be so much more profitable, they can afford to pay you, right? To do different things than what you do today. It's how technology always works. But ultimately, what happens here, and this is why we see companies getting into the trillions and trillions of dollars of market caps, is companies are becoming more and more efficient with technology, which means they can produce goods more efficiently and they can be more profitable when they do it. And so we actually don't need a demographic boom of humans anymore to increase GDP. We can just use AI, blockchain, renewable energy, and other technologies, robotics, etc. Right? Like imagine what happens when Tesla finally gets its robo taxis, and you don't have humans driving cars anymore, and you don't pay for gas, right? Like Uber goes away, and Uber is just no longer a thing with humans or with gas, and so that makes Uber so much cheaper. And so this right here, this new demographic of AI, is the thing that potentially saves the government from printing away its dollar. If this doesn't work, I don't know what happens. Probably we go into hyperinflation at that point because they just have to keep printing money. But if we can get productive enough through technology, we might be able to get away from this the same way we did back in the 60s and 70s, but with AI instead of humans. To me, that's our only chance. Now, how long does that take? It takes a while. We're not there yet with AI, which is why I think these cycles continue, because the pacemaker has to remain. We have to keep the pacemaker in and keep printing money because our GDP is not strong enough yet. As AI gets better, as technology gets better, which maybe we're 5 years, maybe 10 years from that point, then okay, maybe we can take the pacemaker out. We'll go back to these normal weird cycles where they're more irregular and we don't know, we can't predict them with certainty. But we're not there yet. But that is, in my opinion, our only hope. And so until we get there, the governments have no choice but to print money. And that's why I always say it doesn't matter if the yen was going to collapse or if, whatever problem we have, there's geopolitical wars or something breaks in terms of like a financial crisis, the solution is always print money because there is no other solution yet. So we need to wait until we can build that solution. And that to me seems like we're still far away.
Damn, Kai. Okay, we got a big thesis here. Let me see if I can summarize, and then I want to talk about what are the takeaways and how do you invest in this market. But just to summarize, liquidity is what moves the market. As a result of liquidity moving the market and continuous money printing, it causes these 4-year cycles, which we are currently in. We are currently in the 5th 4-year cycle since it started in 2008. What does that cause? It also causes a lot of debt for all these nations, which is why they have to continually keep printing. When was the last time this happened? This has happened before, everybody. History likes to rhyme. It happened back post-war, and it actually happened for 7 cycles. There were 7 of these 4-year cycles where we were printing, and as a result of that, it caused inflation. But compared to the inflation we have now, we're talking 10, 15, 20% inflation. The way that we got out of it last time is different than the way we're going to get out of it this time. Last time we got out of it because of the baby boomers, a lot of babies being made, and a lot of productivity coming into the economy. This time, we can't get out of it in the same way because fertility rates are down and we're not producing babies at that same rate that we were back then. 3.5 babies per woman back then, 1.5 babies per woman now. Not enough. So your thesis is that the way we can solve that would be by AI, but AI isn't at that level yet. We need another, don't know, 5, 10, 15, 20 years until AI is at that level. So until then, it is likely that we continue to be in these 4-year business cycles.
That's exactly it. And then the other just key point is that inflation likely is not going to happen like it did in the 70s because this time the productivity is not driven by demographics of humans that buy things, it's demographics of AI that don't buy things. So there's no need for inflation to come back in large amounts. Like, sure, inflation might spike up a little bit because of things, but not sustained like a decade-long inflation like we had in the 70s.
Okay. So, knowing all of this, how do you invest in these business cycles?
If you understand that liquidity controls everything right now, and again, it won't always happen, so you need to keep an eye on it. At some point, that's going to stop, and then you need to be like, "Oh shit, okay, now my thesis changes, my strategy changes." But at least right now, and until this changes, it's all about liquidity. And so you're looking and trying to understand what are the things that change liquidity, right? One of the big things to understand is that the reason why I think these happen every 4 years, and I don't know for sure, I don't know why it did this in World War after World War II. I looked it up, just noticed it was 4 years. I was like, wow, that's weird. I think what's happening now is governments refinance their debt every 4 years, and they have to pay off their debt. And the way they do that is by printing money. And so basically, it's just 4 years happened because of that refinance. Probably that's what happened back then, but I actually don't really know. But that's what's happening now. At least it appears. And so the key thing to understand here is when we are in a time where monetary policy is such a big part of the business cycle, it means we are debasing our currencies really, really fast. Okay. And so the best thing to do is hold on to scarce assets. Gold is at all-time highs. Why? Because of this exact reason. Real estate, I mean, not at all-time highs right now, but it's because we're not at the top of the business cycle. But real estate has done extremely well since the financial crisis. Why? Because it's a scarce asset. Okay. Now, at some point, maybe 3D printers and robotics and stuff changes that because we can print a million houses. I don't know. But for now, anyway, we're not there. But anyway, stocks, tech stocks, same thing. One, because they are scarce. Two, because, well, they are the technology that's going to save us. So you might as well invest in them. And same with crypto, scarce assets. And same thing, a technology that's deflationary that's going to help for the future of what we're building. And so investing in these assets is the key. Now, again, because we know it's 4 years, and again, it won't always be 4 years exactly, but again, we can kind of understand them because we can just look at the cycles of liquidity and try to understand when liquidity is coming. You can optimize your bets based off that. And so when liquidity goes down, right, in terms of like when the amount of liquidity coming out decelerates, it never really stops, to be honest, but as it decelerates, that generally means bear market. That generally means time to buy. As liquidity accelerates and goes through the roof, right, and gets more and more accelerative and we print more and more and more, those are the times to start taking profits and move back into the dollar, right? Or move back into stable coins or whatever you want. And you basically just try and follow these cycles. These cycles are not the pullbacks like we witnessed on Monday. That's not a cycle. The cycle is 4 years. The cycle is about liquidity, not price cycles that you see, when you have like 13 pullbacks within one cycle kind of thing, within one bull market. What we're looking at is how can we manage our assets? And we know when it looks like we're going to get more and more liquidity over time, thinking 6, 9, 12 months outwards, if we think in 12 months we're going to have more liquidity than we do today, we want to be invested in risk assets, in these scarce assets. When you think we're going to have less liquidity than we do today in 12 months from now, that's when you want to be out of assets. Okay. It's actually pretty simple and pretty straightforward. The problem is there's a million different analysts out there that will tell you all these different things about inflation and this thing and interest rates and blah, blah, blah. And what you need to do is just not mid-curve at all and just go liquidity up, I invest. Liquidity down, I get out. Nothing else. Nothing else matters. That's it. Assuming this thesis works. Doesn't mean it will. This isn't like a perfect science by any means. It's a thesis that until I see doesn't work, I'm going to stick to it. And that's how I'm going to invest. And that's what I'm going to continue to base my strategies on. But right now, I just haven't seen anything to change that. And so when I saw the dip on Monday, I was like, oh, did something change there? It's like, no, we're still going to be in this liquidity world. And so I'll still invest based on that.
Final question then. Where are we at right now in this cycle, and where is liquidity right now?
So you can clearly see these cycles on this chart here. And now sometimes the liquidity amount this is the rate of change of liquidity. This is not the amount of actual liquidity. This is the rate of change. And so that rate of change can be more or less, right? And as it peaks up at the top there at, what do we have there? Like 20% was the last cycle, 15% the cycle before that. These are the kind of things you're looking for is when do we peak out in the cycle? Whenever we peak, that's when you want to get out. Right now, I think we're still around the midpoint. We're at neutral. We're at basically between 0 and 5%. And so probably we're going to get to 10% plus. We might not, but it's very likely we're going to get to 10% plus. I'm looking at the orange line here, which is the 12-month growth change. And so my estimation is we get around that 10 or higher. I don't think it becomes more than what we had last cycle with COVID. So I'm not looking for this to go up more, but I'm looking for it to get somewhere around that 10% line. But more, I'm just looking at how does the macro environment look and feel, right? If we're getting too overheated, and the growth in our economies is getting too good, then the government has to tone it back. They've got to start to tighten liquidity. They've got to start to raise interest rates, et cetera. And so that's all you're kind of trying to understand. Right now, we know we're at highest we've been a long time, and rates are starting to come down in countries all around the world. So it's pretty obvious that rates are going to continue to go down. We're going through a rate lowering cycle. These happen all the time too, right? So we're nowhere near that yet, which means if we're at 5%, and I'm not saying it goes back down to zero like it did before, but we're definitely going down at something. Now, once we go from 25 basis points down and then 50 down and then maybe 1% down, maybe eventually we'll slow it down and we'll go to pause. And when we pause, it's like, okay, now we're done. Now the next move is probably to go up, not down. And at that point, you're like, okay, now it's time to get out. Bear market's coming, etc. And that's the 4-year cycle. And rates, liquidity, you can look at the same thing. They're all kind of similar and intertwined together. So I still think we're about halfway through this cycle, maybe a little past half. I'm not sure. But we definitely have a lot more liquidity to go and a lot lower to go with interest rates. And so for me, I'm still very bullish on this bull market, and I see no reason for it to stop. And that means stocks, that means crypto, real estate. It always lags, so it's just starting. It's just kind of bottoming out now. At least in Canada, I mean, every house is on the market right now because no one can afford it, and so that's just another telltale sign that hey, rates have to come down because everyone's selling their house. If Canadians and Americans can't afford their home, the government has to help them with that. They're not just going to let everyone blow up, right? And don't forget, the governments also have to pay their debts, and they can't pay their debts when we're at 5% interest rates. This is why we go down to 0% every few years, or close to 0%. And so I think the same thing happens here.
I want to know, you guys listening, how much you follow the liquidity cycle, guys and girls. How much do you follow the liquidity cycle? Are you tuned into this, or is this something new for you? And do you want us to dive deeper into this and keep you up to date on a regular basis on the liquidity cycle?
And if you do want it, every Tuesday, our pro members get access to liquidity. So we share liquidity charts every single Tuesday in our newsletter for pro members only. And we give you updates, weekly updates on what global liquidity is doing. It's probably the most important chart you could get if you want to invest. And we share it every Tuesday for you inside of Pro. So all the things that you get with Pro, including our portfolio and everything else, is amazing. This one liquidity chart we show you every single week is probably more important than it all. And so all you have to do is go Pro and you get that. It's well, that makes it well worth your money just right there. So if you want liquidity, do your own research or just go Pro and you'll get it.
One chart to rule them all from the master of charts, Kyle Reedhead himself. Remember, everybody, that none of this is financial advice. Investing in crypto is risky, and you should only invest what you can afford to lose. If you like today's show, smash that like button, subscribe to the show to make sure that you stay up to date on liquidity, or as Kyle said, subscribe to the newsletter and go pro. Link is in the show notes. Thanks so much for listening, and everybody have a wicked awesome day.